I'm going to share with you guys two different trade examples using order flow footprint charts, along with GEX level and basic market structure. Now, if you're wondering what the heck is a GEX level, it stands for gamma exposure level, and this is going to dictate how much the delta will move, and this is information we gain from the options market. So right here, I want you guys to pay very close attention. If we look right up here where it says HVL level 68.45, below that level, we expect higher volatility. So as long as we can stay above it, we expect a more orderly price action. The market moves up, comes back down, finds support, and goes back up and such. And then look at all the positive gamma exposure we have up here. All the green represents the positive gamma exposure. To the downside, though, we do have some gamma exposure on the day we're going to talk about, which is this past Friday at 67.20. So as a mental note, if we're above 68.45, we already want to be thinking long side of the market. Now, when we come over and look at a conventional 5-minute chart real quick, we can see where we have some of the levels already drawn out. Now, the blind levels, these are proprietary levels having to do with mentor Q. However, I don't want to deal with those levels today. Instead, we're going to be looking specifically at the gamma levels. Now, in this instance, we have a gamma 5 level right here. The lower the gamma level, just think about the stronger that level potentially is. Then right down here at the low, you can see that we have call resistance, 0 TTE, and also a gamma wall. But keep in mind that 68.45 that we talked about, looking at that gamma chart, is right down here, and that's exactly where the market bounced from. I really want to pay attention to the bounce we had right here, along with the bounce that we had right down at this level. Now, when we come over, we deal with the first bounce. I'm simply going to draw a horizontal line right across that GEX 5 level. Now, we can see we came into that level right around 12.20. We bounced out somewhere around 12.25. So here we are looking at an order flow footprint chart. And this white line is that same GEX level that we just mapped out. Keep in mind, we said we came in interaction with it right around 12.20 and we bounced out around 12.25. Well, could Orderflow give us a precise entry into this market and show us when the shift occurred between the sellers and the potentially aggressive buyers? Well, if we come down here real quick and we take a look at the delta, I would like to see two increasing deltas back to back. Now we can spot the delta at the bottom of the candle. For instance, right here, we have a negative 368, positive 35, but then we go negative 127 again. Well, negative 127 is a much weaker delta number than that positive 35. However, if you look at the next two 1-minute candles, 209, that's more positive than 127. And then 307, that's even more positive. Now, what I really like about this candle at 1224 is not only is it the consecutive positive delta back to back, and the key there is consecutive. But look what we also have, and we've been talking about this in several videos. Look at all these green dots, consecutive. Look at these consecutive green dots, 1, 2, 3, 4. I want to see 3 or more, and to me, that will signify we have an imbalance in the market. Since we have a green dot next to it, that means it's a buy imbalance, meaning that buyers were aggressively buying the market. Their orders were basically being executed on the ask. Now, it was almost 5, but we had a 1 price point move beyond that. Now, what I really like about this is we have 2 different options if you're using order flow to get into this trade. One, we can get in at the close of this candle right here. Then do we put our stop loss right below that candle or below the second candle that has more delta? That's something you as a trader needs to determine. Would you rather have a much tighter stop loss that you get stopped out more often, but when you're wrong by a smaller margin? Or do you want to give the market a little bit more liberty to swing around? Now, the second way we can get in would be as soon as we saw these imbalances take shape, we could also just go ahead and enter the market, or the next way, as we come down there, see, can we get into that imbalance area? Now, what I like about this imbalance area is this can also give us a way to better position our stop loss if you're a trader that wants to minimize the downside. For instance, once we had the close of this candle, we can say, all right, well, we had 2 things going for us. We had 2 candles of positive delta. Then we had this buy imbalance. So if we got long at the close of that candle, we'll call it 68, 63 and a quarter. We could put our stop loss right below these imbalances. And I'd probably put it below right here where that 24 print is on the candle. And that would be right here at a price point of 68.60. Now, if we measure from there to the opening price, we'd have a stop loss of roughly 2 3/4 points. However, knowing when to get in the market is only one piece of the puzzle. If we were to get into the market right there, when do we then look to get out of the trade? Well, there's a couple ways we can do it. One, we can come over and look at structure for potential clues. Or number two, we can look and see, all right, when do we get an imbalance in the market? And then the market comes back through it. So if you look right up in here, we have another imbalance, but did the market break below it? Absolutely not. So we could have our stop trailed right there. And then if we go up a little bit more, you can see the market ultimately did come right back down there. Now, in this example, if that's what you use for your target, we would be looking at somewhere around a 8.5 point trade. And keep in mind, we were risking less than 3 points on that trade. So that gives us a favorable reward to risk ratio. However, when we come back over and we look at a 5-minute chart real quick, if we would have entered the market right down around this area like we talked about, was there any other clues where we could potentially look to take profits on this trade? This is something I talk about all the time on the live stream. I look for structure breakdown points or breakout points. And the way I go ahead and map this out would be the candle wick right up here to the candle bodies, and look right where the market came right up to. Now, if we go ahead and we look at the order flow footprint chart, look what we have taken shape. We could have got in right here. Then we could have simply exited as we came into that area. That would skew the reward to risk ratio a little bit more in our favor. For instance, if we took that same entry and we exited right at that zone, we would then have the potential to make a potential 11 points on the trade and risking less than 3 points. That would almost be a 4-to-1 reward to risk ratio. Now, you might say, well, Mike, that's great. That order flow junk does not work. Well, let's go ahead and fast forward the tape here just a bit more. Now, before we go over the second example real quick, I want to let you guys know right now, Apex 7A 70% sale off all their evaluation accounts. Best yet, only $40 activation fee once you pass the evaluation. Take advantage of this offer. Use the link in the description box down below. Use promo code Mike at checkout. We come back over and look at the 5-minute chart. Let's just draw our level. Let's just go ahead and drop a horizontal line right down in this zone. Now, notice we come into that zone somewhere in the ballpark of at 1320 or so, and then we bounce out of that area. So now let's come over and look at the order flow footprint chart. Here's the white line right here. And I want you guys to pay very close attention. Keep in mind, as traders, we are looking for clues that the market potentially wants to bounce. You might say, well, Mike, what about right over here? Here's that white line that we already drew out on the 5-minute chart. We had the buy imbalances. Why not go ahead and take that? Well, that would be one solution where we could have just simply took the break of that candle, and depending on when you decide to move your stop loss, maybe it's break even, maybe you let it come all the way back down against you. But look at as we came back down towards this area again with this candle at 1337, we have a series of sell imbalances right here, some more sell imbalances right here, and here's what I'm going to really like about this potential setup. Once we see we have sell imbalances in the market, once the market starts getting back above those sell imbalances, that is also showing us that there's starting to be a shift in the market. This is where a lot of traders got aggressive on the sell side. And guess what? If prices do not continue lower, how do they have to get out of that short position? They then have to become buyers. And look at the very next candle. Notice what we have as we start breaking above these imbalances in the market. We start getting a series of buy imbalances as we're starting to break out above that candle. Now, from that point, now I like it because we have more than one reason to take the trade. Now, unfortunately, we don't have the delta on our side like we had with the first example, but now we have two different stacked imbalances. We had the sell imbalances we were able to overcome, and then we have the buy imbalances, and then even better, if we would have waited until we came back down into this area, we could have looked to get long right within the middle of that zone. Now, in this example, if you would have got long on this candle right here, maybe you took a stop loss. If you had your stop loss right below that area, ideally, we wanted about 2 ticks below that imbalance at minimum. So if you had it 2 ticks below it, well, you missed getting stopped out by 1 tick. But let's just say that we got filled right up here at the tippy top, and we have our stop loss roughly 2 ticks below that area. That would give us a stop loss of roughly 1.5 points. Well, let's go ahead and round this a little bit more. Let's go ahead and give ourselves 2-point stop loss on that trade. And if you look, notice what happens, right? Do we ever come back down towards that area? The simple answer is no. Look at what we have right here. We start to get another series of stacked buy imbalances. So then from this point on, if you're looking to trail the trade, we can now have our stop loss right below this next stacked imbalance zone. Then as we look to continue to fast forward through the market, let's look at the order flow. Do we see anything else that could make us want to get out of the trade? Do we see a series of stacked sell imbalances or stacked in buy imbalances where we can move our order to? And right now, I got to say the answer is no. You can see right up here, this highlighted area, this is going to come from a former stacked imbalance area. This could be an area where we look for a target. But also look what we have right here on this candle. Now we have a series of stacked sell imbalances. So this is showing us that sellers are now starting to get aggressive, and we have a former level over in this area. Now I'm going to go ahead and highlight this area real quick, because as I start to zoom the chart back out, it may get lit. But at some point, if we scroll this back a bit, we're going to see, what do we have right here? We have a series of stacked sell imbalances. So it's really no surprise that the market came right back towards that area. So now let's go back over and look at where the buy entry would have been. I'm just going to go ahead and highlight this whole area down here. Now let's go back over and look at the 5-minute chart. On the 5-minute chart here, here's where we're looking to enter the market. And before we had any real signs telling us, watch out, we might want to go ahead and protect ourselves, get out of the trade, or at minimum, start to aggressively trail the stop up. Notice from that entry point to the bottom of that zone, that would be 16 3/4 points. And keep in mind, that was using a 2-point stop loss on that particular trade. And that is one of the benefits of trading with order flow, where we can get more precise entries, and we can see the shift in the market where the buyers and sellers start to become aggressive in the market.